In the previous video, we already talked about the supply side of the loanable funds market, which is saving, okay, or how savers respond to the change in real interest rate. Now, in this video, we're going to continue our exploration by focusing on the demand side, okay, which is the investment. Here, the very first thing I would like to clarify is investment here does not mean financial investment. Okay? In other words, we're not saying that you save so that you can buy stocks, bonds, and do all kinds of the financial investment. No. As we already said in chapter 10, when we talk about investment in economics, we mean real investment, okay, or business fixed investment. For example, our college purchases an overhead projector, okay, for the classroom, or the HD TV. Okay, so these are the equipments, machinery, and tools. These are what we mean by investment. Okay, in other words, we said in the previous video that on the saving side we have households and governments, right, as the potential savers. On the demand side here, it should be businesses, okay, and when we say they make investment, we mean they make fixed investment. They purchase tools, equipments, and machineries. Okay. Now here, because we already said that this is on the demand side, so let's just draw a regular downward sloping demand curve. Here I use I, which stands for investment. Okay. Now, how could we be sure that this is going to be a downward sloping? Again, as we did before, we just arbitrarily pick 2 points A and B. Okay, you can pick whatever or wherever you want, and then let's see if it goes down. Okay, if we move down along this curve from A to B, you would find that here on the vertical axis, the real interest rate decreases. Okay, and on the horizontal axis, you find that the investment is increasing. Okay, so R decreases, which leads to an increase in investment. Does this make economic sense? Again, I would suggest you to pause the video and try to make sense of this. Okay, we do believe that there is an inverse relationship between the real interest rate and investment. This is because for businesses, the real interest rate is actually their borrowing cost. Okay, so for example, if our college wants to build more high-tech classrooms on campus, so we need to buy more HD TVs, we need to buy more kind of the video conferencing equipments and softwares, okay, and but our president finds that we don't have enough money in our pocket, so we have to go to, let's say, Bank of America or Regions or Wells Fargo and borrow from them. Okay, so we would be charged for the borrowing, and the charge is the real interest rate. Okay, how much we have to pay for each dollar we borrow. So that's why here we said R is the borrowing cost. Okay. Someone may raise a question here by saying that, what if these firms, like especially the big firms out there, they hold enough cash in their pockets for example, Apple, right? They probably hold billions of dollars cash, so they don't have to borrow from a financial institution. If that happens, are we still going to have a downward sloping investment curves? Put it differently, if a business has its own cash, do you still believe the change in real interest rate would change their investment behaviors? Pause the video and try to think about this. We actually believe no matter the business has the cash at hand or not, the change in real interest rate will change its investment behaviors. Because here, let's check out the situation when a business has a lot of cash at its hands, right? So when we see, for example, let's do the interest rate goes up, okay? Interest rate goes up, the firm, if the investment curve slopes downward, is supposed to invest less, right? Regardless of how much money or cash it has. Now, how could this happen? What's the economic intuition behind this? We're going to say that, when real interest rate goes up, the firms actually have two choices, okay? The first choice is invest. In other words, buying machinery, equipment, tools to produce. Okay, for example, Apple would produce Macintosh or iPhones. Okay, and or they could simply lend the money out without any production. So in this case, the firms could be creditors, right? Remember, they get the cash at their hands, so they don't have to produce. If their goal is simply to maximize their profit, they could lend the money out. Okay. Now, with a higher interest rate, you would find the firms are more likely to be creditors. Okay? Because if they continue producing, the profitability stays the same. But here, the real interest rate goes up. That means they can potentially make more money by simply lending out the cash in their pocket, right? So when they become, or more firms become creditors, then we will have less producers on the market. So the investment would decrease as a result. Okay. Once again, here the investment means the purchase of real machinery, equipment, and tools, and only the producers will do that. The creditors won't do. Okay, they don't need any tools or equipment. The producers will lead. So that's why we believe this is still true. Okay, the inverse relationship between real interest rate and investment is still going to be, it will still give us this downward sloping investment curve. Now here, it's a very good chance for us to come back and rethink about R. Previously, we said that R is the borrowing cost, right? How much you borrow, how much you have to pay to get a loan from a bank, right? But here, even for those firms who don't need to borrow, we believe R also measures their potential returns from lending out the money, right? So here we would give a more general definition of R, the real interest rate, which is the opportunity cost, okay, as we mentioned in chapter 1. Because the opportunity cost says how much you can get from your second best choice, right? So if your second best choice is to be a creditor and R measures how much money you can potentially make from being a creditor. Okay, so here we would say R is actually opportunity cost. The borrowing cost is just one example or one application of the opportunity cost. Okay. All right. Now we have both saving and investment. Let's put them on the same graph. Okay. Remember, the saving slopes upwards, okay, and investment slopes downwards, right? So it's just like what we got before here. We find an equilibrium point. Let's call it point A. And here is the equilibrium interest rate. And down here on the horizontal axis, that's the equilibrium quantity of loanable funds. Okay? As we discussed before, if the interest rate somehow lies above the equilibrium level, we're going to find a surplus here. Okay, so people would save more than what businesses need. If the interest rate somehow falls below it, we're going to find a shortage. So because the funds are so cheap that the businesses really want to make a lot of investment, but a no interest rate means saving is not that rewarding, so we won't find enough saving on the market available for businesses to borrow. Okay, so you're going to see a shortage here. All right, so here this is the equilibrium on the market. Again, we can define this as a quantity of loanable funds saved equals quantity of loanable funds invested. Okay, like what we did back in chapter 6. All right, now in the next video we will start shifting the curves. Here it might already kind of pop up in your mind. What we have done is very similar to what we did back in chapter 4. Okay, so we derived the supply and demand curves in the first place, and after that we do the equilibrium analysis, and the last one and the more challenging step is to shift the curve. Okay, we're gonna start doing that in the next video, and you would find that even with this very simple supply and demand analysis, we can later apply this to our fiscal policy discussion. Okay, we're going to talk about billion-dollar questions.